My name is Michael Guyette, publisher of the Lead Lag Report. Joining me there with Tom Luongo. For those who are not familiar with you and have not seen some of your work on Zero Hedge and other places, introduce the audience here.
So I'm Tom Luongo. I'm the publisher of the Gold, Ghosts, and Guns blog, podcast, and newsletter. I'm also an editor for Newsmax at Ultimate Wealth Report and a contributor to Financial Intelligence Report. I've been working for Newsmax on and off for about 10 years now. I do the intersection of markets and geopolitics. And so I look at markets differently than the way other people do, because I'm always looking at politics first and how that informs the landscape. So it's always my framework, which is exactly why Mike and I wanted to have this space today. You're correct. That was the right intro. So thanks for the invite as always.
So I'm gonna read out loud, shared at the top of the space, a snippet that you put in this month's latest newsletter that you pushed out. And this is, from your writing.
Yep.
When it comes to the vigilantes, however, it's taken FOMC Chair Jerome Powell more than a year to tell them he's got their backs if they have his. In effect, Powell himself is becoming the ultimate bond vigilante, calling the bluff of all the other central banks and shadow banks who think they are more powerful than the Fed. Now, I'm starting the conversation with that because I think it's an interesting framework. I myself have stated many times, and I think the evidence is on my side on this, that the bond market owns the Fed. It's not the Fed doesn't own the bond market owns the Fed. Some people disagree. The reality is the bond market has to move before the Fed acts. Mm-hmm. It sounds to me like you think that this time it is different. So lay out the framework there for you around how to think about Powell and the interaction of policy against equity market.
Well, I think that, Mike, we have a, what's the word I'm looking for? We have a lot of experience with the Fed always having to respond to the bond market because we weren't in control of the bond market. We weren't in control of our bond market because we had a Federal Reserve whose debt indexing rate was set by the City of London. LIBOR was in charge of what Fed policy could ultimately achieve, right? Because if LIBOR blew out because British banks got in trouble or European banks got in trouble, or really the Eurodollar system, as Jeff Siders pointed out for years, that there was the Eurodollar futures market that would always foretell when the Fed was going to make their moves. That was fine when LIBOR ran the world. I think the world changed in January 2022 when we finally went to a full SOFR market. And by January of this year, the Eurodollar futures market on the COMEX died. It's now been replaced by the SOFR 3-month future, the 3-month SOFR futures market. All of that former volume is now there. So the value of the hedging for dollars, the pricing of dollars, is now set by the domestic repo market in the United States as opposed to where they were in the past. Because our debt markets were always subject to whatever LIBOR did. It didn't matter whether your bank was in trouble or not. If LIBOR blew out, well, your credit revolver went up, your adjustable rate mortgage went up, your credit card rate went up. And it didn't matter what the Texas ratio of your bank was. Like, you were indexed to LIBOR. By that token, by that fundamental kind of framework, the Fed was never really in control of its own monetary policy, which is the point Jeff Snyder made for years. And I agreed with him as I learned that. I learned that at his knee about 10 years ago. But SOFR has changed the landscape. And so I think our old ways of looking at the way the market reacts to Fed policy, while that's predictable, it's also different this time because we now finally get to see how American banks and American businesses are reacting to Fed policy based on our markets, as opposed to what happens in the over-leverage and blown to the gills offshore dollar markets, the Eurodollar markets, which, by the way, got blown up to nearly infinity because of 10 years at the zero or 12 years at the zero bound. And so we've never really been in this environment before, ever, since the Fed went to a monolithic interest rate for the entire country when under FDR. So I think that's the main reason why I think this time is different. I'm not saying that markets are different. I'm saying that the fundamental underpinnings of what we think of as how the markets have reacted in the past, that's different. And it may have different effects because, look, I'll give the microphone back in just a second and say, look, here we are 2 years into this, or a year and a half into Powell raising rates unbelievably fast, faster than even Volcker and Arthur Burns did in the late 1970s. And everybody who thought, oh my God, if the Fed gets to 1% or 2%, they'll have to pivot and go to the zero bound again. Well, that was that was what we expected because LIBOR was in charge of things. Notice that Powell wasn't reconfirmed, nor was he started to raise interest rates until after all the debt in the United States all new debt had to be indexed to SOFR. And by this summer, the SOFR is now literally the law of the land. And I think that fundamental change is and that timing is very important. And it also explains why Powell had to reverse in 2019 because SOFR hadn't been fully rolled out yet. LIBOR was still in charge of 99% of the 95% of the debt held domestically. So that's the basic framework. Now from there, we can discuss everything else because at this point now, I'm willing to happily to listen to you say why this is going to break a whole bunch of things, which I think it's going to.
No. And by the way, just because I don't disagree, and I'm glad you mentioned that point about LIBOR and the SOFR change, because that's not something that you hear in the traditional media, and it's complicated for a lot of people that are not aware of the global financial flows and what's that a warning sign of stress signals. But that dynamic, though, you correct me if I'm wrong on this, that the biggest impact would still be on the short end, which is rates, which is what the Fed controls, the Fed funds rate itself.
Well, of course.
It's not clear to me if that, maybe there's just not enough data or I'm missing it. It's not clear to me if that's some structural change as it relates to the longer end of the Treasury side, which is really still more market driven despite the balance sheet.
Of course it is. Oh, of course it is. The Fed has always, no argument, the Fed has control over short-term interest rate. The long end of the curve is a different story. And you'll know that you're correct because, well, dude, we're looking at a massive yield curve inversion, right? Like a historic yield curve inversion. But part of, I think the way that's been dealt with, I think some of that is just a hangover of people not understanding the fundamental change in how the markets are now structured, our debt markets are structured. Two, we have a Fed that is at odds with our Treasury Department because Janet Yellen runs the Treasury. She's clearly front-running operations against the Fed. There's a clear, honest to God fight at the top of the U.S. hierarchy. The Treasury is not working and the Fed are not working together. And then I think this is also very real.
Yeah, actually, I'm going to make today. I saw you repost that comment from Danielle DiMartino Booth, who had on a space a couple of weeks ago. It is weird, right? Yellen basically saying the idea of a higher for longer is not a guarantee. And
right.
She said basically, right, well, on whose authority?
Yes, exactly. Last I checked, Janet Yellen's not in charge of the San Francisco Fed, nor is she in charge of the FOMC anymore, even though she nearly tried to run both institutions into the ground. Like I fundamentally, Mike, like from a geopolitical perspective, I don't believe that. I believe that Yellen is a traitor. I believe that she works for the globalists. I like to put her as one of the chief consiglières of the Davos crowd, what I like to call the Davos crowd. I believe that Bernanke at best was just an egghead academic who was left with a bad situation. I don't believe this, but I'm willing to be generous about Bernanke. I think Bernanke and Yellen are both globalists. I think they were both put in charge of the Fed to literally destroy the Fed's ability to set U.S. monetary policy. And I think they were I don't think anybody ever thought that Trump would get elected. And in that opportunity, put Powell in charge, who puts John Williams in charge of the New York Fed, who then implements SOFR. Remember, SOFR was on the books, the Fed had been talking about SOFR for 10 years. And Obama and Geithner both just put and Yellen and Bernanke put the complete kibosh on it. They never let it out of the box because they knew exactly what it would do, which is what it's doing right now, allowing the United States to normalize rates and not immediately break everything and give the Fed optionality in a way that it's never had before in terms of monetary policy.
So I would argue that, so just in this, it's the other part of the conversation around you have breaking. All right. So that's the one liner, right? The Fed keeps doing what it's doing until something breaks.
Yes.
And everyone automatically assumes something breaking is like a Lehman type of situation. But the reality is that I can argue that things are breaking. So if you look at, you look at a 60-40 proxy, an ETF, I've referenced AOM, which is basically 60-40 from iShares. So the total return over the last 5 years is pretty much the exact same as CPI cumulative. So the vast majority of mom and pop investors that have some 60-40 asset allocation model on a real return basis, they've basically made nothing for 5 years already. Now, not that because of the bond side, right? And the sell-off that happened, the yield spike. But that seems like that's great. That's wealth that breaks from the illusion of nominal return.
Of course. I'm not arguing with, I can't even argue that point. I think the whole, I think this is about something much, much bigger than, but we are going to have to accept the fact that the entire pricing system of both bonds and equities and commodities and everything, I think it's all broken. I think it's broken by 15 years of distorted markets thanks to QE, zero bound interest rates and everything else, and that we're going to go through a massive reorganization. They call these recessions, by the way. But I think this is about something much bigger than this. This is about an existential threat to the Federal Reserve as an institution. And it's about whether or not we want to have commercial banking going forward or we want to have central banking, replace commercial banking. Now, clearly, the model in Europe is to move to a central bank digital currency model, to move to the end of commercial banking and the move away from any kind of individual control over anything. And I think this is fundamentally a philosophical fight over the private formation of capital versus the public formation of capital. And if you look at, and that's my frame. As far as all the little details of how these markets operate, I don't do that at all. So I'll bow to your wisdom on this, on whatever you do. That's your gig. That's not my gig. My gig is to back out from the 40,000-foot level and go, what's the lay of the game board? Who's playing the Atreides? Who's playing the Harkonnens? Who's playing the Emperor? I'm doing a Dune metaphor. And who's trying to win the game board by who's trying to control Arrakis? That's the way I'm looking at this. And those are the factions that I see. And I say, okay, well, what weapons would they bring to bear? And clearly they're always using interest rates and leverage as the mechanism by which to buy and sell governments, to buy and sell politicians and all the rest of it, and the set policy. And I think that's where I live and breathe. And so I look at SOFR as a strategic asset. How does that get deployed? It's a weapon. I look at LIBOR as a strategic weapon. I look at the ECB. Okay, so what's its strengths and weaknesses? And you just do SWOT analysis on all of these institutions. I think this is an incipient sovereign debt crisis. And I think there's going to be commercial fallout, clearly. But this is about what central banks can go bankrupt here. This is going back to like shit that Jim Rickards talked about 18 years ago. The next crisis is going to be in the central banks. And Jim made it abundantly clear. He's like, the goal here is to roll everything up into the IMF to bail out all the central banks who go broke. I'm like, yeah, if nothing changes about the structure of the system as it's currently constituted, absolutely, Jim was correct. But I don't think anybody really expected the tail risk from global with central, that the Fed would go, you know what? No. Or that the US banks would go, yeah, no. I want to get back to net interest margin lending on pipelines and rebuilding roads and other military boondoggles and all the rest of it. And we'll leave the regional banking to building libraries in Des Moines. Like, that's the way it's supposed to work. And we could get back to that if we really want to. And then the question is, how much shit do we have to break in the process? A lot. But I think you break certain sovereign debt markets that were propped up for years by a Fed working as the proto-central bank of the world. And now they're the ones metaphorically swimming naked and standing on the shore naked, and the tide's gone out. And now the moment we're living through right now is that moment when everybody's beginning to realize, oh yeah, they are all swimming freaking naked. And then the question this is again, riffing off of Martin Armstrong, who's been writing about this for years, saying, look, that's what we're dealing with here. And the flood of global capital that would happen under those circumstances may just overwhelm all of the history that the previous cycle's data, because that system operated under these parameters, and the parameters were that the Fed was either a captured pawn or complicit in building the system. And now the Fed has said, you know what, we're not doing it. And so what does that world look like? And that's the way that's my framework. Again, I may be wrong about this, and I'm happy to be challenged on it, but I think it's at least something we have to consider when we go through this. I think Lynn Alden the other day somebody said that this is like the 1970s all over again. She's like, oh, it's not, it's the 1930s all over again. Or it's the it's the late 1920s or the early, she said the 40s actually. But I think she's right. I think in that we could be looking at a sovereign debt crisis that rivals the 1920s, that has a massive influx of foreign capital into the United States and into a dollar that goes from the dollar index that goes from 106 to 140. What's that going to break? Oh, looking everything, right? But what's it going to look like on the back end? It's also going to look really bad. That's why I'm like, I'm very, again, happy to be challenged on this and happy to have people like look through what's already broken and what hasn't broken. Again, I don't look at things those ways. I know Danielle looks at things differently you do, and you're looking at like the nitty gritty on these things and what is going to break here. I think it's going to break a lot. I don't know what. That's for people whose subject area expertise is in those types of correlations in markets. That's not my area of expertise, or it's not my focus as an analyst.
So two things.
Mm.
One is I definitely don't want to ever imagine Powell naked, just to be clear.
For Yellen, for that matter.
Or yeah, no, definitely not. That's number one. Number two, I'm going to make the assumption that, because I like the way that you frame that existential threat, right?
Mm-hmm.
It's interesting timing around SOFR, LIBOR, existential threat, and Fed now, right? Which I'm not seeing as much kind of coverage on as far as what that's doing at activity level. But yeah, it does seem like the Fed is trying to take actions maybe quietly to just take more direct control from things like this outside of the commercial banks.
What I would say about Fed now is that we have a clearing system that is antiquated beyond all get out. Hell, there's like parts of it are still using like fax and telex and shit. Let's not kid ourselves. I have no fear of a wholesale central bank digital currency to modernize the payment rails. I have no problem with that. Is the Fed trying to consolidate power? Well, most likely. I didn't say the Fed was a good guy here. I'm not making that argument. I'm not giving up my Austrian economic libertarian bona fides here. I'm just saying that for right now, the Fed may be our best asset to fight even worse globalist powers that want to do away with everything, to do away with all private formation of capital, which is when you listen to these people talk, that's what they're saying. If you look at their policies, that's what they're saying. If you look at how they're breaking structurally on top of breaking fundamental markets like the car market and the food market and everything. They're like, these people are literally breaking everything on purpose. They are vandals attempting to break everything. The rule of law, our culture, everything. And in that respect, if the Fed says, well, that's fine, you want to break everything? Well, you're going to do it at 6%, not 0%. And I think 6% is way too expensive for them to pull that off. And then it just collapses their whole silly notions about the fourth industrial revolution and all the rest of it. And then we can argue about how much power we should take back from the Fed after they break these people. That's a fundamentally different conversation. But that's not a 2023, 2024, 2025 conversation. That's a 2030, 2032 conversation.
So in the initial back and forth, you mentioned the ECB and Lagarde. So let's talk about just Europe in the context of all this and ECB, because the reality is, as much as everyone rags on the Fed, the ECB is equally as fucked, just like the Bank of Japan is equally as fucked, maybe even more. But what's the response by the ECB and what's the interaction though?
I think the ECB and I don't think Powell. I do not think that Christine Lagarde has Powell on her speed dial. I don't think Jerome Powell has Lagarde's. I don't even think. If Powell interacts with Lagarde at all, it's to text her randomly, suck it, Chrissy. I'm dead serious. I think they hate each other. I think they're absolutely at war with one another. I think, and the ECB is a fundamentally flawed institution. It can go bankrupt, unlike the Fed. The Fed can hyperinflate the dollar and make the dollar worthless, but it can't go bankrupt, right? Because it can print its own balance sheet. The ECB can't do that. All right. And again, I used to think that I used to believe that the ECB was going to replace the dollar. I used to be an extreme dumb libertarian who thought these things. And then I actually listened to people and actually went through it like, no, this is correct. The ECB has no centralized taxing authority. It has no ability to issue bonds. It is the United States as if with a central bank where Mississippi could issue debt at California's credit rating. That's the ECB. ECB is they're not equally fucked by the Fed or anybody else. The Fed still has control over the value of the most powerful currency in the world. Whether that currency is flawed or not is a different issue. Whether it's got a long lifespan is another issue. I'm talking about today, right? So how do you taper a Ponzi scheme? Well, if you're the biggest Ponzi scheme, you taper all the other Ponzi schemes. And if you don't think I'm correct about that, go look at FTX and all and look at FTX, and it was a Ponzi Hoover for a whole bunch of really bad, smaller stable coins to hoover up all the cash and all the value into FTX and then issue magic beans. Well, guess what? Good news for you. If you think that the dollar is a magic bean, which you could make that argument, I'm not saying you shouldn't, but then you can hoover up the ECB and the Bank of Japan and the SNB and the Bundesbank, and you can hoover all them up as well. They're all Ponzi schemes, but they're smaller, less powerful Ponzi schemes. And so the ECB was the main beneficiary of the Fed's largesse as the zero bound and with QE under Bernanke's rates in 2018. He didn't have the infrastructure to normalize rate in 2018. because again, LIBOR ran the world. And so the minute that Europe, remember, it was in December 2018, he raises interest rates and the world screamed that he raised 125 basis points too hard. And then he immediately had to turn around along with Draghi in January's meeting and cut rates again. Remember? And he had to cut rates more than he raised them. That was the effect of LIBOR. LIBOR blew out. And then banks in Europe got in trouble. Some banks in the United States got in trouble and he had to cut. He had no choice. But because SOFR was still in pilot program stage. And this time when he went to raise, he hasn't backed off a bit. And we've seemingly weathered a lot of this. Not to say that there aren't things that are broken. A lot less is broken than people expected. And I'm not saying that we're not going to get our hair mussed, to quote George C. Scott from Dr. Strangelove. This is financial nuclear war between central banks. That's the way I see it.
By the way, if you haven't written a piece with that title, I encourage you to, because I just changed the name of the space. How do you taper a Ponzi?
Oh, I have.
Yeah.
I have. I'm actually already quoting myself. I wrote a big article about, I called something like, so LIBOR, this, that, and the death of Ponzi, and the death of the Ponzi scheme. I actually explained that entire argument about 3 years ago, I think. Yeah. I'll find a link to it.
You got to pull that up and I'll repost it. Yeah. That I am curious to hear your thoughts on the constant news flow you hear or ideas out there around, BRICS are going to challenge dollar hegemony, all this stuff. And I am very skeptical myself. Mm-hmm. But what's your take on this idea that BRICS are going to just replace the dollar over time?
I think they are for their own. This is the thing, Mike. I think that Powell understands that the global reserve currency, the dollar as the global reserve currency, is a burden we can no longer afford. Triffin's paradox and all that stuff. I buy it. And I wouldn't think any of this if Powell himself didn't say this. On Humphrey Hawkins' testimony, I've said this many times, in Humphrey Hawkins' testimony I think it's about 2 years now, he said, look, I think there's room in the world for more than one reserve currency. It's in the congressional record. The FOMC chairman said that, okay? Meaning he already understands that this is what has to happen. And so there's no way for us, since we've weaponized the dollar so badly through horrific foreign policy decisions, mostly, in my opinion, run by our British greatest ally, sycophants in Washington and our masters in the city of London and others. And I don't absolve Europe of this. I don't absolve American oligarchs of any of their complicity in any of this. It's all one big circle jerk of suck, right? But to deny the effect and the influence of foreign powers, not just Europe, but China and all of it. It's clear that they weaponized the dollar and destroyed the convenience premium of the dollar by turning it into a bludgeon. The minute there was any challenge and threat on any vector of U.S. power, be it military, industrial, so China on the industrial front, Russia on the military front by going after our assets in Syria, our project in Syria, right? And financial, right? And now the Russians and the Chinese are going after our financial hegemony over the colonized global South by telling countries like Egypt, oh, by the way, don't pay your IMF debt back. We'll backstop you. We'll cut your debt load. We'll restructure your debt if the IMF is willing to. They're playing that blackmail with the IMF. The IMF, of course, is saying no, until eventually they have to say yes because they don't have any choice. These things are already happening. So the BRICS, what they're doing is they're just building, I think they're building a digitized gold-backed trade settlement system, meaning they'll settle up all their relative trade balances in tokenized gold held on each other's balance sheets. It won't be a perfect trustless system in any way, but it'll be a more trusted system than they currently have, right? It doesn't have to be a perfect system to replace the crappy deal they're getting today. Just be better. And then, if that's the case, then capital will move into that system. It doesn't mean that they don't all distrust each other at a fundamental level. Of course they do. But never jump to the end game when there's 17 or 18 steps that have to go along the way. You can get 3 or 4 or 5 steps along that path, and the whole thing could fall apart. But then what happens when you get 5 steps down that path? How does that affect the United States? How does that affect the City of London? How does that affect Zurich? How does that affect Frankfurt? Right? These are the questions you have to be asking, not immediately go to, well, it won't work. Well, yeah, it'll work if the incentives are still there, and it'll work for a period of time to move the world away from the old system towards a new system. Doesn't mean that new system is going to make it. We may get detoured off of that, and there may be a negotiation where we wind up with a hybrid system, which is what I think is going to happen. And I think there are going to be payment rails in place to allow this to happen. I think it's very clear that like the Bank of International Settlements will probably survive to be one of the conduits between East and West. I think I did a podcast with Vince Lanci the other day, a couple of weeks ago, where we talked about the rise of mercantilism and the fact that the gold is going to stop flowing across borders, the end of the COMEX, all that stuff. I think that's all on the table. So I don't think anybody wants any of this. I think they're doing what they have to do because of the push for centralization of power into a global system of financial feudalism, which is what's coming out of City of London and the European Union, and had been coming out of the United States when they were a willing partner of those two other institutions or other vast groups. That's what's pushed the BRICS to do what they're doing. Okay. I think that we've now, once everybody in the US, once people in the US realize that system doesn't work for them and they had the opportunity. This is the key. Had we not elected Trump and not gotten Powell into the Federal Reserve and not put John Williams at the New York Fed, we wouldn't have SOFR. Okay. So without those things, without Trump getting elected, oh, by the way, JP Morgan and Goldman Sachs would still be the vampire squid. They would still have to be going along with it because they wouldn't have any other option. If they wanted to survive in any form, they would have to have gone along with whatever was being planned for them. But the minute they got the opportunity to set something in motion, a counter effects in motion, they took their opportunity and I think they're running with it. And I firmly believe that there's a split at the top of the banking hierarchy in the United States. And I've said for a long time, I think that Morgan and I think JP Morgan, Goldman Sachs, I think Citigroup to a lesser extent, and Morgan Stanley to a lesser extent, I think are all on kind of Team USA. And then BOFA, Bank of New York Mellon. I think Wells is also on Team USA, but they're a San Francisco bank. So they're like the black sheep of the squad, of the whole thing. And then you got like Bank of New York Mellon, BOFA. I don't know. I'm not sure about Citigroup at this point. They're so over levered that they could be anybody's bitch at this point. They're on Team Davos, and that's very clear. You know what I mean? And so I think that when you break it down that way, it's pretty clear. But there's like multiple financial wars happening. There's the New York Fed versus the San Francisco Fed. There's the Fed itself versus the ECB. There's the Bank of Japan who's just trying to survive. Oh, by the way, Japan's not nearly as fucked as everybody thinks. There's plenty of capital within Japan to allow the BOJ to allow rates to rise, and they're going to defend the yen. And everybody who thinks that Japan is going to go under is going to get fucking rolled. And they better watch themselves carefully. The Bank of Japan is going to move.
By the way, I don't disagree necessarily with that. I don't think it's a debate. Japan gets fucked. Everybody else gets fucked because of the reversal of the carry trade when that happens. For a moment in time, it's the global market.
Oh, yeah. There'll be a margin call against Japan.
Right.
And
that's for the...
And then the Bank of Japan will come in with, they have $100 billion in cash sitting on their balance sheet. They will dump it in and they will let the bond market go and they will defend the yen. Every time the yen gets to 150, expect the Bank of Japan to step in. Ueda is coming in very carefully and doing like little targeted ones here and there. He's trying not to rock the boat too badly. Right. And I still think he's working with Powell. I absolutely think that the BOJ is still on the Fed's wing. And I do believe that. And I do believe that Ueda, curve control, wants to end QE. I believe he doesn't have any choice because we're looking at a commodities future. We're looking at a commodity inflation, another wave of commodity inflation that they won't be able to contain. And they can't have Mrs. Watanabe going and looking for yield somewhere else. But then Japan's truly.
Now, by the way, Tom, there's nothing you said which I at the core fundamentally disagree with from a framework perspective.
Right.
I think, and so I'm glad just to clear this up. The back and forth you and I had was really ultimately about what you correctly identified as about what is it we're addressing from a time frame perspective. So I think people confuse. They think I'm bullish on long duration treasuries from like a buy and hold perspective. I have no opinion on it.
Okay.
Right? We go to 14% like Santelli's saying, or 13%.
I think 9 is fair. I think
Right. Well, maybe, right. But between now and then,
right.
the question becomes: would Treasuries act as your relative safe haven against equities collapsing around? That's what's been missing. Right?
Yeah,
and then these credit spreads to widen, which is why I keep going back to, I think, all these arguments around Treasuries failing against equities. They're missing the critical ingredient. The critical ingredient is you need to have default risk premiums rising.
Yeah, I think I'll be honest, Mike. What I think is the following: money is going to ground. Literally, it's not about the return on your capital; it's the return of your capital. And we've reached a moment in time where I said this a few weeks ago, and I haven't said this recently. So I'm gonna re-up this talking point that I was putting forth in July and August, which is the following: people need to stop thinking about the ECB as a first world potential safe haven and developed market. We need to start thinking about Europe as an emerging market. And so if they have an inflation problem, you need to start proving to me that, God damn it, there's positive real yield to be found from a 3% German 10-year, right? This is what I want you to, if we get that fundamental shift in perspective that the German Bund is not a safe haven asset, what does the market look like to you? Then all of a sudden, everybody is having a real crisis of faith about
100%.
About sovereign, about debt, and all of a sudden,
100%, no question.
Now,
right, and my only contention would be the question becomes, okay, would that, I think it would transfer over into the corporate credit side, which again is what's been missing, right? It's at some point a sovereign crisis has to metastasize into a corporate credit crisis because at the end of the day, governments have to tax to deal with the crisis they themselves made, unfairly having it be the citizens that pay for it and corporations.
Well,
I think that's sort of the philosophy.
Again, that's one side of it. They can tax more or they can spend less and deal with it that way. And so now we got to start looking at what's happening on Capitol Hill, right? So now the question is, I think the missing piece is that no one believes that Congress is going to stop spending. And I have been, since the day I said that if Powell is serious about tightening before he tightened by raising the reverse repo rate by 5 basis points above the Fed funds rate in June of 2021. If Powell, which he started the global supply of dollars in June of 2021, before he started raising rates, before he started shrinking the balance sheet, if he's serious about that, he has to then be serious that this is now going to be that at every level, we're going to have, oh God, I think I'm losing my train of thought on this. We're going to have this. If he's serious about that, he's serious about going all the way to the mat to bring us to the political crisis where we're going to have to cut spending. Where we're going to have to make a choice between some kind of appropriate risk assessment as translated into interest rates, right? That's what interest rates are supposed to do. They're supposed to tell us what the risk to investment is. Or are we going to spend, or are we going to continue to spend like in ways that make drunken sailors embarrassed? Like we have that is the fundamental choice here. And I think that if we learned anything this week, it's that the fiscal conservative on Capitol Hill have the hammer right now, but they wouldn't have that hammer if we were at 1%. They have that hammer at 5.5% or maybe even 6%. And if we have another round of commodity inflation coming, which I think we do, I think yesterday's slacking of the Brent crude market was hilarious and insane, since Russian Urals grade is literally selling at $85 a barrel. And that means that Brent should be selling at 92 or 95. Like, how the fuck are we trading $85 on Brent crude $85 on Brent crude this morning? It's insane. Clearly, there was a lot of liquidation in the oil markets and the copper markets and everybody's looking for dollars, Mike. It's just a massive run into dollars right now. What happens after that? Well, like, money's getting to ground. Where does it go? I don't know that we're necessarily, I think high quality corporate credit could do okay after. It's going to be the first thing I think to recover. I think we're going to have a thing where it looks like we're going to have a situation where it's going to be tangible assets rule and debt rules. And then that basic framework, it doesn't matter what it is, that's going to truly become a four-letter word. And again, I'm with Martin Armstrong on this one. Like all the way down the line, I think he's right that's what we're dealing with. And yeah, I don't know what is LQD? What's the yield on LQD right now? Like 4.9%, and JNK is like 6.9%.
Yeah. Well, under real credit event, those will widen, and AAA will be there's no question. Right?
Absolutely.
Absolutely. That's what I think is what I keep saying. Phase 2 of credit event.
Yes.
It's got to be the corporates. But I want to get some of the audience because they've been waiting very patient.
The basic idea, and again, I'm more of a qualitative guy than I am a quantitative. Okay, in this respect, I do quantitative trading technical analysis. But really, when it comes down to this, I'm being sincere here. I'm not trying to dodge the question. I picked 6% out of my ass 2 years ago. I said, look, I think Powell will go to 6%. I mostly picked that number because I thought it would just literally shock everybody to tears. I honestly didn't think I was going to be correct about that call. I just said that if Powell is serious about doing it, he needs to bring the 10-year back to something like the long-term run rate on what the 10-year should be yielding, right? There's a reason why they brought us to the zero bound, because they wanted infinite leverage and they wanted infinite at-bats to run whatever their dumb project of the day was, be it climate change or tranny bathrooms or whatever the hell it is. You pick the thing that they're willing to do, right? But are they going to be able to do that it doesn't matter if it's 6%, it's just X%, where they have to borrow at X% and then they can't lever up at 6%. When you're levered 10 to 1 at 6%, and you're paying 6%, like if you're levered 10 to 1, like you go broke on an 8% move against you. Your equity is wiped out, right? It's the same thing. Like if it's at 0%, you're screwed. You're screwed less. You've got more margin for error. You can always just go borrow money at 0% to go shore up your balance sheet if the market moves against you. But if you have to constantly keep borrowing at 6%, you get wiped out that much faster. You get the margin call that much quicker. And then the expense of the margin call eventually bankrupts you. And so that's the point on this. And what we've seen over the 15 years of NERP and ZERP, especially at NERP in Europe, $14 trillion at one point traded at a negative nominal yield. I mean, we're all sitting here talking about how so much U.S. debt held up just in the U.S. is under 25-30% underwater. Can somebody explain to me how European banks aren't 50-60% underwater when a German Bund was negative 0.6%? Can you understand why Lagarde has literally spent a year trying to keep the German 10-year Bund from breaking above 2.5%? Maybe now you understand, because they can't afford to see any bigger holes in the balance sheets. And here's the thing, guys. It's not the commercial banks in Europe whose balance sheets are impaired. We already know they're zombie banks. They've been zombie banks for 15 years. It's the central banks in Europe that have the massive holes in their balance sheets. And all the ECB can do is move deck chairs around on the Titanic. Just shuffle piles of money from one pocket to the other. That's all they can do. That's all the ECB does. And they've mostly shunted all of that debt onto the Bundesbank's balance sheet. And they bankrupted the Bundesbank. Like there's a German auditor came out 2 months ago and said, the German Bundesbank needs a bailout. It's got a $2.5 trillion hole in its balance sheet. If the German Bundesbank is bankrupt and needs a bailout, what does that say about the entire European banking system? Right? We're talking about the Bank of Italy. When you go, do me a favor and start really go look at the charts of all of the European 10-year debt, the German Bund, the French 10, the Spanish 10, the Dutch 10, the Italian 10, and you will see yield curve control. You will see yield capping. And all of that started to blow out 3 weeks ago, where Lagarde lost the ability to defend both credit spreads and the euro at the same time. On Monday, I told my subscribers in the article that Mike, the thing I excerpted and threw out that tweet, which Mike started the space with, that was in an article named Beware the Kalends of October. The Kalends are the first day of the Roman calendar. We all know about the Ides or the E-days. But the Kalends of October, I'm like, I expect once the quarter shows up, everybody's just going to look at the pricing of these markets and go, this is just all completely mispriced. And it's exactly what we saw. For 2 days, there was massive, and even in the week leading up to it, there was massive turmoil in the bond markets around the world. And then that spills over into the equity markets. It spills over into gold. It spills over into silver. It spills over into copper and everything else. Why? Everybody's like screaming for dollars because everybody's biblically short still dollar. Brent Johnson's not wrong. Dollar milkshake theory isn't wrong. Okay. What it is it's going to describe a short-term phenomenon, 12, maybe 18 months. So the mechanism here is that it's about the offshore dollar markets losing their ability to infinitely lever up outside of the Fed's control dollars to lend into the world. Okay. That's what this is about. The Fed is taking back control over the value of the dollar, which is their primary product. It's what they sell. And shouldn't they control the value of it? I think so. If I'm thinking about it from the Fed's perspective, I'm no Fed apologist here. I'm just thinking about things from the individual perspectives of the people who are out there playing this game. I think the game sucks personally. Oh no, absolutely. The RRP facility is down from $2.5 trillion to under 1.5. One of the things I said at the beginning of this process, I had Daniel DiMartino Booth on my podcast in February. It's the first time I had a chance to ever talk to Danielle for real. So it was a real treat for me because at that moment I was like, oh my God, I think I'm not just some fringe guy off in the corner sitting on my back porch, literally smoking a cigar and hoping my dog doesn't bark at the deer in the park, right?
Although in the very beginning of the conversation, I did hear a dog barking.
Yeah, that's Kamina. She runs around and she's doing her thing. She agrees with me about everything, by the way, because the sun rises and sets in my ass as far as she's concerned.
Again, more imagery. I don't.
Right. So yeah, no, I'm good at this, Mike. I am a writer at first, after all, and everything else second. The point is, I brought this idea up to Danielle, which is that, look, Powell built a $2.5 trillion liquidity war chest on the one side of the balance sheet, and he's got a $5 trillion liquidity collateral slush fund on his balance sheet on the other side. So if the U.S. banking system needs liquidity, hey, we can take money out of RRP and we can put it and we can move it back into the money markets or wherever it needs to go. We can move the money. We'll move out of RRP and move back into the markets. If it's liquidity, the market needs collateral that can actively sell treasuries off of its balance sheet if it needs to. It doesn't really want to book the loss, mind you, so it's rolling them off. But again, I watch the H.4.1 report every week, and the Fed is shedding $95 billion a month in treasuries off its balance sheet. And I got news for you, dudes. $95 billion worth of treasuries are not rolling off the Fed's balance sheet every month. The Fed has to be doing some selling. Okay. So someone's willing to buy those treasuries to get collateral. Now they're getting that collateral at a good rate because they're buying it at higher yields and the Fed's having to take a bit of a bath, but it is what it is. Like, and when I said that to Danielle, she said, you're absolutely right. Like he built Yellen and Bernanke built him the war chest on the collateral side, and he preloaded the massive tightening cycle by first going and draining $2.5 trillion of liquidity from the global markets. And remember, I look at the RRP facilities like global M0, right? Because those are dollars that can no longer be levered up into M2, global M2, M3, can't be lent out through the shadow banks, right? If you look around and you ask yourself the question right now, at 5.5%, where would you, at 5.5% Fed funds rate, where are you going to buy a loan that you think you can get 7 or 8? Well, at oil with $95 a barrel, I think there's 8% returns in oil and gas, right? Or coal or something like that. Go look at coal prices. They're about I think we have, in order to decide what supply chains need to be rebuilt, we need to have risk properly assessed. And by moving the Fed funds rate up, we now make priority decisions about what's important to invest in and what isn't. When you're at the zero bound, everything is investable. And the point of raising interest rates, and I'm just going back to basic Austrian interest rate theory here, right? That's what we do. That's what interest is supposed to reflect, right? And that's why I'm, again, no fan of the Fed funds rate. And I hope that at the end of the day, that SOFR can obviate in the long-term perspective the need for even a Fed funds rate, because SOFR has that ability. We don't even need a Fed funds rate if we've got SOFR. We let the repo market set the price of money. We don't need the Fed to do this. And that actually then gets the Fed back to what it's supposed to do, which was its original conception, which was to provide elastic money to the banking system if there was ever a liquidity crisis. But we're so far from that model and we've all grown up and lived in this fucking weird world that it's insane. And we're having a real hard time. Like, oh my God, could we actually get back to rational banking? And we're like, and our first response is, no, that'll never happen. But it's beginning to happen. It's right here. You know what I mean? Like, maybe we can dare to dream a little. I really do. I think gold was leased out, but I don't think that the physical gold went anywhere. And at the end of the day, force majeure, we own it. You can have a claim to it. You get paid in dollars. Like, we'll pay in dollars. We don't care. Like, we print those. But that 8,133.5 tons of gold that we have on our balance sheet, we have those. We have those ounces. I believe that. And I believe that the Chinese have more gold than they say they do. I believe the Russians have 3 times the amount of gold they say they do. I believe that central banks buying gold and now are 15 to 20% of the market this year. They can be 20% of the total gold demand this year. And they've been 15 for the last 2 years. Poland is buying 20 tons of gold a month, guys, to defend the zloty against the European breakdown. Poland, 20 tons a month. Even the Bank of Japan has bought gold recently, right? China is buying 20 to 30 tons a month at this point. The Turkish banking system is accumulating gold at an astounding rate. The Turkish gold reserves are not the property of the Turkish central. Gold has been remonetized in Turkish banking for years. So the total gold flows that you see from the World Gold Council every month reflect the total gold that has moved through the Turkish banking system. Serbia is buying gold, has been for years. It's beginning gold. The central banks are all gearing up for the return of mercantilism, as Vince would put it. And you should really have Vince Lanci on, Mike. I would recommend you do this and have him discuss the mechanics of this stuff with you. Absolutely. But I do believe that the United States has this gold. And I also believe that that the COMEX is going to die and that only trusted merchant banks are going to be allowed to move gold in and out of the United States. And you will be able to buy gold officially, by buying GLD or SLV or something along those lines, but you'll never actually get gold to get paid in dollars. That's not to say that the United States is going to shut down like APMEX or any of the coin dealers. They're not going to do that. They don't care about the retail amount of gold. They worry about central banks going onto the COMEX and trying to take 200 tons out of the country, right? That's not going to happen. We're closing that window because they're getting prepped for a return of gold to the global monetary system. Because if they don't do it, the BRICS are going to make it happen. And if that's the thing everybody's scared about, gold is actually the technology everybody's gearing up to have returned to the system because it has to. Because how else are you going to deal with the actual debt? How are you going to collateralize this? You're certainly not going to collateralize it with the Fed holding $11.04 billion in their balance sheet in gold reserves, 42.22 an ounce. Now, at some point, the Fed is going to throw gold out of the yield curve and they're going to recapitalize the United States that way. That's one of the ways they can do it. There's other ways of doing it through Fannie and Freddie and a couple other things, but that's a different discussion for a different day. The easy one to understand is imagine the U.S. Treasury, once we get fiscal control over this insanity in Capitol Hill, and we have something close to a balanced budget. Hey, let's just go back to the 2018 budget. That would be nice. And then we have a presidential administration and a Fed and a Treasury Department willing to issue 50-year debt with a 5% gold redemption clause that they fully intend to buy off 20 years later at a higher price, but with a 2%, let's just say like a 1 or 2% dollar coupon, but a 5% gold cover, a gold redemption clause. And that's when you can see the Fed allowing, hey, yeah, let's let the price of gold go up 20% a year. We'll make all our investors happy. And that's how you recapitalize the entire system. And that's doable. We could sell 1,000 tons of gold that way or 2,000 tons of gold that way to investors. And by God, man, we can pay for all the boomers' Social Security. We can do it. And then the unfunded liabilities all of a sudden not a problem. If we balance the budget and pull back on the empire and do all the things that need to be done, that the American people want that. It's amazing how we're not doing that. Part of the problem I have with most financial analysis is that all is dependent upon these ideas that certain things never change. That Powell has, that the Fed has now set the groundwork for fundamental political change. And fundamental political change doesn't happen until you're in a crisis period. Neil Howe, the Fourth Turning, talks about this. It's like we don't reform when everything's fat or when we have money and everything's fat and happy. It's when we should do it. We never do it. We wait until there's a crisis. And we're forced to do it. So.
And I have a crisis on my calendar.
You got to get going.
But for those who want to track more of your work and thoughts, where would you point them to?
Point them to my blog at tomluongo.me or goldgoatsandguns.com. You can go to my Patreon, sign up for the Patreon at patreon.com/goldgoatsandguns. And obviously you can follow me here on X/Twitter or whatever Elon Musk is calling it this week at TFL1728.
Appreciate everybody joining. Again, this will be an edited podcast. Tomorrow I've got David Rosenberg, Tavi Costa, so it's going to be another good day of conversations. Thank you, Tom. I'm glad we actually got to this place where it turns out we both agreed with each other, just different perspectives in terms of what my objective is, right?
Absolutely.
It's yours as a longer term thinker, which I agree with. So, thank you, everybody.
Thank you.
Cheers, everybody.